Okay, so last class we talked about the design of a tax system, and we said we would care about two features of this tax system. The first is efficiency. The second is equity. And we started this section on efficiency, and we defined a efficient tax system. So basically, if a tax system have smaller debt with loss and smaller administrative burdens, then this tax system is more efficient. And then we defined the concepts of average tax rate and marginal tax rate. So basically, if you need to calculate average tax rate, then it's the total amount of tax paid by the taxpayer divided by the total income of this taxpayer. And then marginal tax rate is really the additional amount of tax you have to pay if you have additional dollar of income. And today we talk about lump sum tax. So just by the name, you would see that lump sum tax essentially means that it is a tax which charges the same amount on every taxpayer. For example, if the Manitoba government says anyone lives in Manitoba has to pay a tax of $400, regardless of your income, your earnings, your actions. In this time, this is a lump sum tax. And you can see that this type of lump sum tax is the most efficient tax possible. Why it is most efficient? Well, the reason is because the same amount of tax will be imposed no matter what type of action you want to take. So this implies that charging this tax will not change incentives. And if incentives will not be changed by this tax, then this tax will not cause debt with loss. This is just one criteria of evaluating the efficiency of tax system. We also want to evaluate the efficiency by administrative burden. And you can see that this is a very simple tax because you're charging everyone the same amount. So in the end, you can see that the administrative burden on this tax is also very small. Okay, but I can see that if you think about this lump sum tax, then you will see that potentially, from a social perspective, people will dislike this type of tax because people would think, well, you charge the same you charge the same amount of tax whether this person is rich or poor, then this potentially implies a lump sum tax is unfair, right? Because if a guy has $1 million, you charge him $400 as tax. And then another guy has only $1,000. Then you will still charge him the same $400. So you can see that this seems quite unfair. So what's the example of a lump sum tax? So I basically got this picture using Google search. So you can see that this is a poll tax. So basically, I guess 100 years ago in Louisiana, if you wanted to vote, then you have to pay this $1 tax. So you can see that in this case, no matter who you are and what is your income and what you do, as long as you want to vote, you have to pay this $1 tax, right? So this is a lump sum tax. Okay, let's review this section. What is meant by the efficiency of a tax system? And we said there are basically two measures. The first is the deadweight loss. And obviously we have discussed deadweight loss several times in previous chapters. So if you have any difficulty understanding what is a deadweight loss, then you could check those chapters. And then the second measure is administrative cost, right? And we know that this administrative burden can be actually imposed on both government and taxpayers. As a taxpayer, you have to file tax every year, and as the government, you have to set up a agency to ensure that everybody is reporting their tax correctly. So what can make a tax system inefficient? Well, if you have answered the first question, then the second question is pretty obvious, right? So if a tax system has larger deadweight loss or larger administrative burden, then this tax system is more inefficient. Okay, now let's talk about the second topic. Remember, the first topic is about efficiency, and the second topic is about equity. And this is obviously a quite important topic, right? Because if you watch TV or if you read newspaper, you can see that the major debate is not about the efficiency of tax. Generally, politicians or reporters, their main concern is about the equity of the tax system, right? That is, how this tax burden is distributed among different people. Obviously, as taxpayers, most taxpayers will want to pay a lower tax, right? So this guy, Russell Long, had an interesting ditty about this. So don't tax you, don't tax me, tax the guy behind the tree, right? Okay, so basically so if we have a goal to design this tax system, then besides efficiency, we will want the tax system to be fair, to be equitable, right? But you can see that it's actually somewhat subjective to judge how equitable this tax system is. And here, we will try to use two principles to judge how equitable this tax system is. The first is called the benefits principle. The second is called the ability to pay principle. And then the ability to pay principle can be divided into two kinds of principles: vertical equity and horizontal equity. So let's first start with the benefits principle. Just judge from the name, you can see that benefits principle basically says, as a taxpayer, if you enjoy larger benefits, then you should pay more. Right? So what are the examples of benefits principle? So the first is the gas tax, right? So if you don't drive a car, then you don't need to pay gas tax. But if you drive a car, then you will actually use roads. So in this case, you will pay this gas tax. And then this gas tax will be used to build and maintain roads. So in this case, you can see that people who use the roads would pay the gas tax. And people don't use roads, they don't pay gas tax. So this gas tax is designed according to the benefits principle. And then the second example is generally you have higher. So generally, if you have higher income, you will have to pay higher income tax. So in this case, that this kind of design again fits into this benefits principle, because if you're wealthier, you could benefit more from public service. For example, if you have a bigger house, if you have nicer cars, then you will actually get larger benefit from police services, right? So in this case, if you are getting larger benefits from these public services, then you should pay higher taxes to fund these public services. Now, the second principle is called the ability to pay principle. Again, judging from the name, it's pretty easy to understand, right? It basically says if you have higher ability to pay the tax, then you should pay more. And then there are two different variations of this principle. The first is called vertical equity. So it says larger ability to pay, then you would pay more. And then the second one is horizontal equity. It means if you have similar ability to pay, then you should pay the same amount. On the surface, right, these two variations look quite easy to understand. And it seems like ability to pay principle is the way to go. But you can see that when you're trying to implementing this principle, this vertical equity and this horizontal equity, they're actually quite ambiguous, because how do you measure this vertical equity, right? How do you precisely measure this horizontal equity? That's the difficult part. So as I said, it's hard to measure this vertical equity. To be more precise, even we know that richer person should pay higher tax, but we don't know how much higher, right? So the majority of the debate on income tax would be about exactly how much more should this richer person pay, right? Okay, now let's look at this these three tax systems. So here we have different levels of income, right? From $50,000 per year to $200,000 per year. And then you can see that we have three different kinds of tax systems. So we have three different designs. And then in each of these cases, we always have this same result if you're looking at the amount of tax. What you can see here is as your income increases, right? As your income increases, the amount of tax you pay always increases. So if you're just looking at the amount of taxes these tax players are paying to the government, you would think that this is a fair system. But if you look at the percentage or the average tax rate, you will get a different perspective. So let's look at the percent of income, right? So basically you can see that in the first tax system, no matter what is your income, you always pay 25% to the government. In the second case, which is more interesting or weird, in this case, at the income level of $50,000, you pay 30%. But if you earn $200,000, you pay 20%. So here you can see that as your income increases, the percent of income decreases. That is, the average tax rate decreases as your income increases, right? And then the third case, it basically shows you that your average tax rate increases as your income level increases. So you can see that under these three different tax systems, the average tax rate or the percent of income changes in different directions when you increase your income level, right? For the first one, The first one is called proportional tax system because the proportion of your income paid as tax is the same, no matter what is your income level. And then the second one is the regressive tax system. So here, as your income increases, a larger fraction of your, as your income decreases, a larger fraction of your income will be paid as tax. So this is regressive. And then the third case is progressive tax. So as your income level increases, a larger proportion of your tax will be paid. As your income increases, a larger proportion of your income will be paid as income tax. So if you look at these three different kinds of systems, then you can imagine that generally in most countries, we will have this, right? Progressive tax. Okay. Now let's look at these three examples, which will give you examples on these three different kinds of tax systems in our real life. So this is the state income tax in the US. What you can see here is some states in the US, right? Colorado, Indiana, Michigan, Pennsylvania, Utah, and some others. These states, they have this flat, let me see, they have this flat income tax, right? For example, if you look at Utah, right, it's 5%. It means that no matter what is your income level, right, for state income tax, you always pay 5%, right? So this is a proportional tax system. Now, what is the regressive tax system? The regressive tax example can be given by this sin tax. So basically, sin tax is this exercise tax which is imposed on certain sin goods, right? Maybe I should add sin goods here. So these goods are considered to be harmful to health or to society, such as alcohol, tobacco, right? So basically, if you buy alcohol or tobacco in certain countries or in certain provinces or certain areas, you have to pay additional tax. So in this case, this sin tax can be considered as a regressive tax. The reason is because so generally these alcohols, tobacco, and tobaccos are consumed by poorer people, so they have lower income. However, they have paid. However, to purchase these consumptions, they have to pay higher tax. So in this case, you can see that this is an example of regressive tax system. Now, progressive tax example. Well, this is pretty easy to find because most income tax system is the progressive tax system. So the following table gives us the personal income tax in three Western Canadian provinces. I forget the year. I think it's maybe it's 21/7. So you can see that the personal tax system in Alberta, BC, and Manitoba are all progressive, because you can see that as your income increases, right, the tax, the percentage becomes higher and higher, right? Okay. Now let's talk about horizontal equity. Horizontal equity basically says that if these taxpayers, they have similar ability to pay tax, then they should pay similar amounts of tax. But then you would run into this problem that how do you exactly precisely quantify similar, right? How do you determine whether these two taxpayers are similar or how similar these taxpayers are? So let's see this example here. So the Smith and Jones families, they have the same income, so $50,000. And then the Smith family has no children, but Mr. Smith has a medical expense of $20,000 per year. And then the Jones are in good health, but they have two children in university. So their tuition bills per year would be $30,000. Now, in terms of charging these two families taxes, we would want to think about the following questions, right? So, should these two families pay the same tax because they have the same income? Well, it seems like this is reasonable, right? But then you can see that the Smith family could argue that, hey, we have this medical expense, so maybe we should pay lower tax, right? And then the Jones family could argue that, well, we have to pay this tuition bills of $30,000. Maybe we should pay lower tax, right? So you can see that there are really no easy answers to these questions because it's very hard to measure similarities between different taxpayers, right? And we know that the horizontal equity is based on similarities between different taxpayers. Okay, now let's talk about this old topic we discussed before. That is tax incidence, right? We discussed tax incidence in previous chapters. The basic idea is, first, no matter who you want to charge taxes, right? If you charge sellers or if you charge buyers, in the end, this does not matter. In the end, the tax burden will be shared by buyers and sellers. So that's the first result. Then the second result is the tax burden, the tax incidence is based on elasticity of demand curve and supply curve. So basically, if the demand curve is more inelastic, then buyers will have to burden larger tax. By the same reasoning, if supply curve is more inelastic, then sellers will have to share a larger burden of tax, right? Okay, now let's see how the tax incidence is related to this tax equity. So let's see this example here. So Australia charges the luxury car tax. So basically, if you buy a very expensive car, right, you will have to pay this additional tax, which is charged in addition to sales tax. Now, think about this luxury, so what's the name here? Luxury car tax in the context of tax equity. It seems that this satisfies vertical equity, right? Because if you're a car buyer, if you can buy a very expensive car, then this implies that you have the ability to pay higher tax. So according to vertical equity, then you should pay higher. You should pay higher tax. But if you think about the tax incidence in this case, you will have some additional insights. So think about this. If we draw out the supply curve and demand curve for luxury cars. Now, what you can see here is demand curve should be quite elastic, because we know that demand for necessity is inelastic, and demand for luxury goods is more elastic. And if we assume demand curve is more elastic than supply curve, now let's look at what would happen if we charge this luxury car tax. Right? So you can see that if we charge a tax like this, right? Remember, tax is always a wedge between the demand curve and the supply curve. Now what you can see here is the fraction shared by buyer is here, very small, right? And this lower part is the fraction of the tax shared by sellers. So what you can see here is, in the luxury car market, in the end, sellers will bear the majority of the car tax. So in the end, buyers, they won't pay a lot of tax. They won't share a lot of tax burdens. And then if you think about this, this will have interesting implications, right? Because this implies the tax burden will likely fall more on car workers, right? And these car workers, they are generally not wealthy, right? So from the perspective of tax incidence, this luxury car tax looks like a bad idea. Okay, now let's look at these simple questions. Explain the benefits principle and the ability to pay principle. Well, so benefits principle basically says if you enjoy larger benefits from public services, then you should pay higher taxes. The ability to pay basically means you should pay tax according to your ability, right? So to be more specific, we could have vertical equity and horizontal equity. So vertical equity says if you have larger ability to pay, then you should indeed pay a higher tax. Horizontal equity says if taxpayers have similar abilities to pay tax, then they should in the end pay similar taxes. Why is studying tax incidence important for determining the equity of a tax system? Well, the reason is because on the surface, the government can say, oh, I am charging tax on buyers or on sellers, but the true burden will be determined by tax incidence. So through our research on tax incidence, we could truly understand the equity of a tax system, because we want to understand the true burden of a tax. Okay, the last question. So City of Winnipeg has approved a new tax to fund research and teaching at FOBE. So everyone will pay $1,000. Is this tax progressive, regressive, or proportional? Obviously, first, this is a lump sum tax, right? Because everybody is paying the same amount, no matter what is your income is. And whether it's progressive, regressive, or proportional, well, if you carefully think about this, you can see that it's actually regressive. The reason is because, think about this. Let's say we have two people, right? So person A has an income of 1,000. Okay. let's use the number 10,000. And person B has an income of 20,000. So if we look at the average tax rate, right, for A, it's 1,000 divided by 10,000, so it's 10%. For B, it's 5%. So in this case, you can see that B has a larger income than A. But now, B's average tax rate is actually lower, right? So this is precisely the definition of a regressive tax system. So basically, you can get a general result here. That is, a lump sum tax is regressive. Okay, great. Now let's discuss the true-false question. Okay, first, lump sum taxes are equitable but not efficient. This is wrong, right? Because the correct statement is lump sum taxes are efficient but not equitable. Why it is efficient? Well, because we just discussed this in our lecture note. Basically, it does not affect incentives because because no matter what you do, you will always have to pay the same amount of tax. So behaviors won't change because of the tax. So this will not cause debt with loss. And it's also because if you charge everyone the same amount, then this tax is really a very simple tax. So in the end, the administrative burden from this lump sum tax should be very small. And then it's not equitable because you can see that it is a regressive tax system, right? We just talked about this. And according to our measure of equity of the tax system, we know that we have to maintain this vertical equity. So basically it means that if a person has higher income, then this person should bear larger tax. So basically this implies a progressive tax system is more equitable. A regressive tax system, is less equitable. Okay. Second, according to the benefits principle, it is fair for people to pay taxes based on the benefits they receive from the government. So this is true, right? This is essentially the definition of the benefits principle. Next, the administrative burden of complying with the tax laws is a cost to government, but not to taxpayers. Well, this is not right, right? Government needs to pay the cost, but taxpayers, they also have to pay the cost, because obviously, if you're a taxpayer, every April you have to file tax. Right? So this is false. Fifth, when a tax does not have debt with loss, the reduction in surplus is exactly offset by tax revenue connected by the government. Well, this one is harder, right? The correct answer for this problem is this statement is correct. Now, let's look at this very old picture. That is, why do we have debt with loss? Right? Why do we have debt with loss? Well, we know that debt with loss is measured by this blue triangle. So let's see why do we have this debt with loss. So first, we can see that after imposing tax, the consumer's surplus. So the consumer surplus will change by A and B, right? Or the consumer surplus will decrease by by A and B. And then the producer's surplus will decrease by C and D. And now what is the increase in tax revenue? Well, tax revenue will increase by A and D. So you can see that the total decrease in the total decrease in surplus is given by A, B, C, D, right? And then the tax revenue is given by A and B. So essentially you can see that there is this debt with loss because the tax revenue is actually given by A plus D. Okay, let me change this. Okay, this should be D here. Okay, now why do we have this debt with loss? Well, first, look at the total decrease in surplus. The total decrease is A, B, C, D. And you can see that this decrease can be partially offset by tax revenue, right? So A and D can be offset by tax revenue. However, B and C cannot be offset by tax revenue. So that's why B and C will become the debt with loss. Now this essentially implies that if the reduction in surplus can be exactly offset by tax revenue, there will be no debt with loss. Again, in this case, we have debt with loss because the reduction in total surplus is larger than the increase in tax revenue. So if the reduction is equal to tax revenue, then in the end, we won't have any debt with loss. Okay, now let's look at 6. An efficient tax system is the one that imposes small debt with losses and small administrative burdens. Well, this is exactly the definition, so it's true here. The equity of a tax system concerns whether the tax burden is distributed equally among the population. Well, if you look at this, it seems that this is correct, right? But if you think about this carefully, you can see that this is incorrect because this specific word here. So, equity of a tax system does not concern whether tax is distributed equally. It actually cares about whether this tax burden is distributed fairly. So you can see that the word equally is incorrect because equally basically means everybody should pay the same tax. And we know that this is not the correct way of designing a tax system. So this is false. Now the last one. Debt with losses arise because a tax causes some individuals to change their behavior. I think we talked about this in the previous chapter. So this is correct. So basically because of the tax, some buyers, they won't be able to buy this product. And some sellers, they will not sell this product. Right? So to be more specific, you can see that these buyers, they won't buy the product because now the price is higher than their willingness to pay. And then these sellers, they will not sell the product because now after imposing tax, the price received by sellers is lower than their cost. So you can see that in this case, both these buyers and sellers, they will change their behavior. So this will create debt with loss. Okay, great. So now we can move to the next chapter. So basically the microeconomics course can be divided to larger parts. The first part is basically about the market equilibrium. So it's about the analysis of demand curve and supply curve. And then the second part is about production. So it's about firms. That is how firms determine the price and quantity they wanted to produce. Okay, so to understand firms' behaviors, we will first understand the costs of production. So basically, we could actually connect the second half of this intro to micro to the first half. Remember that the central tool in the first half is the demand and supply curve. It's this guy here. Now, you might wonder, how could you get this supply curve, right? Or where does this supply curve come from? Well, the second half of this intro to micro, when we are talking about firms' behaviors, then you will understand how could you get this supply curve. Essentially, we will understand how firms, they would determine the price and quantities depending on the type of markets they're operating. Okay, so let's think about different types of markets here. Obviously, we will just think about this using very simple examples. Okay, so you can see that for Winnipeg, we have basically two internet providers, Shaw and MTS. And for electricity, we have only one provider, right? We have only Manitoba Hydro. So essentially, in the future, you will learn that in this internet provider case, we actually have duopoly. And then in the electricity provider case, we have monopoly. In the future, you will learn that if you have these different numbers of firms in the market, then you will have different types of market. And then in these different types of markets, firms' behaviors, that is, firms' pricing and production behavior would be different. Okay, let's first start with the definition of firms' profits. The motivation here is if you want to understand firms' behaviors, then you really want to first start from defining profits, because firm's purpose is about maximizing its profits. So to understand how this maximization behavior will affect the firm's pricing and production, we have to start from the basic, that is, firm's profits. Now let's look at this very simple case. So here, Hungry Helen has a cookie factory, and she buys flour and hires workers. She then sells cookies to consumers. Now, we define total revenue, total cost, and profit. We have learned about total revenue, right? So basically, total revenue is the price times quantity, right? Or following the lecture note, the amount a firm receives for the sale of its output. Now, total cost is the market value of the inputs a firm uses in its production. And then profit is the difference between total revenue and total cost. So let's see this extremely simple example, right? So if Helen sells 1,000 cookies at a price of $2, then total revenue is basically 1,000 times 2, which gives you 2,000. Now, to calculate her profits, we have to calculate her costs, right? Now, this is the tricky part. It's actually quite subtle to accurately calculate her costs. So we would first start with the definition of opportunity cost. So basically, opportunity cost is the thing you have to give up, right? So basically, you can see that if you're watching this video, then maybe you have to give up the joy of watching TV. So here, the joy from watching TV is the opportunity cost you have to pay to watch this video. And then you can see that this notion of opportunity costs will be applied to the firm's calculation of cost, right? So basically, a firm's cost will include the opportunity costs of producing its output. So let's assume Helen pays $1,000 for this flower. And here you can see that this $1,000 is the opportunity cost, because you can imagine that instead of using $1,000 for purchasing this input, then Helen can actually use this $1,000 to do other things, maybe a vacation in Hawaii. So the benefit of $1,000, right, she could enjoy from vacationing in Hawaii has to be given up for this production input. So this $1,000 is a opportunity cost. And then it's a explicit cost. Just from the name, you can see that the cost here is explicit. Well, the reason is because when you're paying this cost, you can actually see that you're paying out some money, right? You can see the outflow of your money. Now, let's think about the second type of opportunity cost, which is more subtle. So let's say we assume Helen could earn $2,000 working as a computer programmer. In this case, you can see that this is a opportunity cost, right? Because if Helen chooses to operate this cookie factory, she could not become a computer programmer. So she has to forego this $2,000, right? This is clearly a opportunity cost. But this is also an implicit cost, right? Because in this case, Helen is not actually paying out money, right? She's not paying out this $2,000. So it's implicit. Now you can see that we basically have two kinds of opportunity costs. The first is explicit opportunity cost. So in this case, it's the input cost, which requires the outlay of money. Then the second type of opportunity cost is the implicit opportunity cost. So in this case, it does not require a outlay of money by the firm. So basically, you can see that for explicit cost, you will actually see the flow of money, right? And in the second case, for the implicit cost, there is no flow of money, right? You cannot see the trail of money. And to understand opportunity costs is very important in understanding how to calculate a firm's profits. And economists and accountants, they're different in how to understand firms' costs and how to calculate profits. For economists, we are interested in how firms make decisions. And when firms are making decisions, firms will compare revenue versus both implicit opportunity cost and explicit opportunity cost. So economists would include both explicit and implicit costs. And then for accountants, well, the purpose of accountants is to keep track of the money which flows into and out of firms. So you can see that their main focus is to measure the explicit costs. So they would generally ignore the implicit costs. So basically, economists and accountants, they have different goals and purposes and functions. So they will record firms' costs in different ways. Now let's see this example, which tells you how to measure implicit and explicit costs. So let's say to build her factory, Helen uses $300,000 and interest rate is $5. Now, what or how costs would be measured by economist and accountant in this case? Well, what you can see here is first let's think about the simple case, right? The accountant case. If there is a accountant, she would only care about the explicit cost. So she would only record $300,000 as the cost. Now what about the economist? Well, for economist, first, this $300,000 would be explicit cost, right? That is, you can actually see that she pays out this amount to buy her factory. Now, there is this additional implicit cost. That is, if Helen uses this amount to buy her factory, she wouldn't be able to earn interest income from this 5% interest rate. That is, she has to forego this amount of interest rate if she wants to pay $300,000 to buy her factory. So you can see that, importantly, this interest income is also an opportunity cost. And it's an implicit opportunity cost because cannot actually see she pays out this interest payment. Right? Okay, now let's see the second case. Let's say Helen uses $100,000 of her savings and a loan of $200,000, and we assume the interest rate is still 5%. Now, what about accountant? Well, accountant would see first, Helen pays out this amount, and second, Helen borrows this amount, and in the end, Helen has to pay the interest expense, right? So in the end, the explicit cost would be given by Helen's own money, and the loan Helen has taken from the bank, and the interest payment Helen has to make to the bank. So essentially, you can see that these are explicit cost, right? Again, economist, we have to think about the implicit opportunity cost. What you can see here is Helen is using this $100,000 of her savings to buy the factory. Again, this implies that Helen has to forego the interest from the $100,000, right? So the $100,000 times 5% is the amount of interest payment Helen has to forego. So in this case, this interest payment is the implicit opportunity cost. So you can see that because economists and accountants measure costs differently, they will actually measure profit differently. What is the definition of profit from an economist's perspective? Well, an economist will measure a firm's economic profit. So we would care about economic profit, which is defined as the firm's total revenue minus all the opportunity costs. So here the key is all the opportunity costs, which means we have to include both explicit and implicit opportunity costs. And then in the other case, that is from an accountant's perspective, right? An accountant will measure a firm's accounting profit. So in this case, accounting profit is defined as the firm's total revenue minus explicit cost. So you can see that in these two kinds of definitions, the starting point is always the same, right? So it is always about firm's total revenue. But the difference is, how do we measure cost? For economists, both explicit and implicit cost will be counted as opportunity cost. And for the accountant would only care about explicit cost. Again, why do we have these differences? Well, because economist and an accountant, they have different purposes. The economist, her purpose is to understand firm behavior. And firm's behavior is determined by total revenue and all the opportunity costs, including explicit and implicit costs. And an accountant's purpose is to record the flow of money in the firm. So the accountant will only care about total revenue and explicit costs, right? Because implicit costs don't have money trail. So this picture gives us a very clear idea how economists and accountants would calculate economic profit and accounting profit, right? So you can see that the height of these two bars would give us the revenue of the firm. And then you can see that for an accountant, right, accounting profit equals revenue minus explicit costs. And for an economist, economic profit equals revenue minus total opportunity costs, which includes both explicit costs and implicit costs. So here you can see one very simple result. That is, accounting profit is always larger than economic profit, right? Okay. Now let's see this example here. So farmer Mcdonald gives banjo lessons for $20 per hour. One day he spends 10 hours planting 100 worth of seeds on his farm. What opportunity cost has he incurred? Well, first, explicit opportunity cost. Think about this. What is the explicit cost in this example? Well, it should be $100, right? Because the farmer uses the $100 to buy seeds, then the farmer cannot use the $100 to do other things. So this is a explicit opportunity cost. Now, what is the implicit opportunity cost? Well, you can see here, if he spends 10 hours planting seeds, he wouldn't be able to use the 10 hours to teach banjo lessons. And for per hour, he earns $20. For 10 hours, he earns $200. So to plant seeds, he has to give up $200. So you can see that the total opportunity cost is actually $300. What cost would his accountant measure? Well, this is simple, right? We learned accountant would only measure explicit cost. So here, the accountant would only measure this $100 of explicit cost. Next, if these seeds yield $200 worth of crops, does McDonald earn an accounting profit? So obviously you have to understand what does accounting profit mean here, right? Accounting profit is basically the difference between total revenue and explicit cost. Right? So what is the total revenue here? The total revenue is 200, right? So it's 200 minus 100, which gives us 100. So from accounting perspective, there is $100 accounting profit. Now the last question, does he earn an economic profit? Well, to calculate economic profit, we have to compare total revenue versus explicit cost and implicit cost. So now we get minus 100. So this basically says from the economic profit perspective, the farmer does not earn an economic profit, or more precisely, the economic profit is actually negative, minus $100. Okay, so let's talk about production. Right? So first, we want to think about production and the production costs in the short term. So here we want to assume that the size of Helen's factory is fixed. So to increase the quantity of cookies, Helen can basically increase the number of workers. And you can see that this is a quite reasonable assumption. The reason is because if we are thinking about the short-term firm decisions, clearly it's very hard for a firm to expand its factory in the short term. However, hiring new workers to increase production is more doable in the short term, right? Okay, now let's talk about production function. Well, obviously, if you wanted to think about firm's optimal decision, you have to think about a firm's production. So how do you understand a firm's production? Well, we could use production function. So a production function is basically the relationship between the quantity of inputs used to make a product and the quantity of output for that product, right? So it's really the relationship between output and input. So let's now see this picture here. So here you can see that we have a table which sort of has everything we need. But here our focus, at least for now, would be just the first column and the second column. What you can see here is, obviously, as you increase the number of workers, then the output, that is, the quantity of cookies, will also increase. So the production function is basically given by these two columns, right? Remember that a production function gives you the relationship between input and output. So we can actually draw out these two columns, right? So what you would do here is you will basically plot these points, right? So basically you can see that, So basically you can see that if we have 0 workers, output would be 0. So if we use horizontal axis to indicate number of workers and vertical axis to indicate the quantity of output. Now you can see that this is the first point. Now what about the second point? So if you have 1 worker, then you would produce 50 cookies. Great, now we have the second point, right? Now what about the third point? 290, right? So 290, which is just this. And then 3120, so 3, right? You can see that it's 3 and 120. And then we have 4 and 140. Right? You could continue to do this. And in the end, you will get all these dots. So after getting all these dots, you will connect these dots. Right? So this curve will give you the production function. Okay. Now let's define the important concept of marginal product. So marginal product means the additional output you can get if you have 1 additional unit of input. Now let's see this definition here. So we could examine the definition of marginal product in this table. So the marginal product is given by the third column. So here our only input is these workers' labor. So we will call the marginal product as marginal product of labor. Now, let's compare these two pairs. You can see that as you increase the number of workers from 0 to 1, output increases from 0 to 50. So marginal product is given by 50 minus 0 divided by 1 minus 0, which gives you 50. Now let's again do a second exercise. So you can see that if number of workers increases from 1 to 2, then output increases from 50 to 90. So this gives us 40. And then by the same process, right? So this would be 3 minus 2, 120 minus 90, which equals 30. So it's quite easy to calculate. Marginal product has a very important property, which is called diminishing marginal product. So it basically says that as you increase the quantity of your input, the marginal product will decrease. Obviously, diminishing basically means decreasing, right? So let's see whether we could see this in this table. So if we compare these two columns, what's your observation? Well, you can see that as you increase the number of workers, right? The marginal product decreases. So your number of workers increases from 0 to 5. Marginal product decreases from 50 to 10, right? So this is an interesting result. Why do we have this kind of result? Why marginal product is decreasing as you increase the quantity of labor in the cookie factory example? Well, let's again think about this in the context of this example here. So remember our assumption here. We have assumed Helen's factory is fixed, right? This basically means the kitchen size of this cookie factory is fixed. So you can see that if you have only a few workers, then these few workers, they can have easy access to Helen's kitchen equipment. And then you can see that if Helen increases the number of workers, still the size of the kitchen keeps the same. This basically means these additional workers, they will have to share equipment with those original workers. And this kitchen will become more crowded, right? So eventually, the kitchen is so crowded that these workers will actually start getting in each other's way. So you can see that because that the kitchen size is fixed, as more and more workers are hired, each additional worker will just contribute fewer additional cookies to this cookie factory.